Hold on tight, Broadcom investors. Google and Meta have just dropped some major news, and it could mean big things for your portfolio. Glowing Star want to know why? Stay tuned because we're diving into how Broadcom stands to benefit from the explosion in AI data center spending and what this means for its future. Hi, welcome back to TheFinanceSavvy, the place where we break down the latest trends and insights in the world of investing, especially when it comes to the next big tech breakthroughs. If you're new here, don't forget to subscribe to stay updated on all things finance. And if you've got any questions, feel free to reach out in the comments or shoot us a message. In today's video, we're going to explore Broadcom and how Google and Meta could be the game changers for this semiconductor giant in 2025. We'll break down Broadcom's role in the rapidly growing AI data center market, the significance of custom AI chips, and whether now is a good time to buy their stock. So let's get into it. Why Broadcom is poised to benefit from Google and Meta's huge AI spend. Let's set the stage. 2025 is shaping up to be a massive year for big tech companies, with Meta, Alphabet, Google's parent company, and a few other tech giants planning to spend $320 billion on capital expenditures, and a big chunk of that money is going into AI data centers. This is great news for Broadcom investors because Broadcom is sitting right in the middle of the action. But before we dive into the details, let's talk about why AI data centers matter so much. AI data centers are the heart and soul of modern AI research and applications. As you've probably heard, artificial intelligence is eating the world, and these massive data centers are where AI models are trained. And as you might imagine, all this data crunching requires insane amounts of computing power, the kind that NVIDIA chips are famous for. But hold up, because here's where it gets interesting. The rise of custom AI chips, Broadcom's hidden strength. Broadcom isn't just another semiconductor company. It's playing a pivotal role in the AI data center revolution. While NVIDIA gets a lot of love for its GPUs, Broadcom is quietly providing some of the most critical chips in these AI data centers. You see, Broadcom manufactures chips for network switches, which are responsible for making sure data flows efficiently across servers. But that's not all. Broadcom's custom chips are getting a lot of attention from major players like Meta and Google. Meta's custom AI chip, the Meta Training and Inference Accelerator, MTI, is based on Broadcom's technology. Google has also been working closely with Broadcom since 2015 to develop its Tensor Processing Unit, TPU, one of the most important pieces of hardware in Google's AI data centers. During their most recent earnings calls, both Meta and Google had nothing but praise for their custom chips. Meta's CFO, Susan Lee, shared that they're already using MTI for ad and content recommendations, and they're planning to expand its use throughout 2025. Meanwhile, Sundar Pichai, CEO of Alphabet, Google's parent, shared that Google's TPUs are seeing strong uptake, with their 6th-generation TPU proving to be a solid performer. This all means that Broadcom's chips are about to be in high demand as Meta and Google expand their AI capabilities. The custom AI accelerator trend is only getting bigger. What's even more exciting? Custom AI accelerators, like those developed by Meta and Google, are way more efficient than the traditional GPUs that NVIDIA makes. As big tech continues to scale its data centers, even the smallest improvements in efficiency can have a huge impact on profitability. So, as Meta and Google ramp up their spending in 2025, they're increasingly turning to custom chips, and Broadcom is there to help. But it doesn't stop with Meta and Google. ByteDance, the parent company of TikTok, is also one of Broadcom's top customers, and Apple could soon follow suit. Broadcom's chips are integral to many of the next-gen systems that companies are building to take control of their AI development. The AI chip market is expected to grow by $60 to $90 billion in the next 3 years, and Broadcom is on track to maintain a dominant market share. In fact, last year, Broadcom was responsible for around 70% of the custom AI accelerators market, which translates to a $12 billion revenue stream. If Broadcom can keep its share, it could nearly double its total revenue from this market alone. But what about the stock price? Okay, so Broadcom's future looks bright, but here's the kicker: valuation matters. Broadcom stock currently trades at a 37x forward earnings ratio, which, while reasonable given the company's growth potential, feels a bit steep at the moment. With expected earnings growth of 30% this year, Broadcom's price-to-earnings to growth, PEG, ratio sits at 1, which suggests that investors might be overpaying for future growth. So what's the verdict? If the stock price dips closer to 30x forward earnings, it could become much more attractive for investors. Or, if Meta and Google end up increasing their usage of Broadcom's chips more than expected, the stock could eventually outperform expectations, making a strong buy for the future. But hold up, before you rush off to buy Broadcom stock, stay tuned because next we're going to dive into Arista Networks and Palo Alto Networks, two other tech giants whose stocks are trading at lower prices than you might think, and they could offer serious upside in 2025. These stocks might be a better value play compared to Broadcom right now, and you won't want to miss it. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to The Finance Savvy for more insights on the latest in tech investing. Got questions? Feel free to reach out. We'd be happy to help. Stay tuned for more deep dives into stocks that are shaping the future of technology. See you in a few seconds. S&P 500 is about to soar in 2025. Two stock split stocks you need to buy now: Arista Networks and Palo Alto Networks. The S&P 500 is on an unstoppable rally, and history shows it's not slowing down anytime soon. But here's the kicker. There's still huge growth ahead. And today, we're diving into two stocks that are primed for big gains in 2025, Arista Networks and Palo Alto Networks. And yes, both just split their stocks. Stay tuned to find out why this is a once-in-a-lifetime opportunity for investors. Hi, welcome to The Finance Savvy, where we break down the latest in stock market trends, big investment opportunities, and key insights to help you make smarter financial decisions. If you haven't already, make sure to subscribe so you don't miss out on future updates. Got questions about these stocks or want more tips? Feel free to reach out in the comments. I'd love to hear from you. In today's video, we're going to explore why history says the S&P 500 will continue to surge in 2025 and how Arista Networks and Palo Alto Networks, both with recent stock splits, are perfect stocks to buy right now. So let's dive in. S&P 500. The bull market continues. The S&P 500 has been on a bullish run for over 2 years, and with gains of 23% in 2024 and 24% in 2023, the question on everyone's mind is, how much higher can it go? Well, the good news is, based on historical data, we're just getting started. Over the last 50 years, the S&P 500 has been up 78% of the time, and after 2 consecutive years of gains exceeding 20%, the market has typically posted an average 12% return the following year. 2025 could be another massive year for the market. But here's where it gets even more exciting for stock investors. Companies that do stock splits tend to see strong stock price gains after the split. This corporate action signals to investors that the company is performing well and likely has a bright future ahead. Two major names that have recently split their stocks are Arista Networks and Palo Alto Networks, and we're going to dive into why these companies are worth a closer look. 1. Arista Networks, the AI networking powerhouse. Let's start with Arista Networks, ANET. This stock has been a long-term winner, up 66% in the last year and a jaw-dropping 2,880% over the past 10 years. Why? Arista's networking technology is in high demand, especially with the rise of AI. They make high-speed switches that connect data centers and servers, and with AI workloads growing rapidly, Arista's products are in huge demand. Arista just completed a 4-for-1 stock split in December, and despite the stock's impressive performance, the valuation is still attractive. Arista's forward P/E ratio of 56 might seem high, but when you look at its PEG ratio of 0.95, it's actually undervalued for a high-growth stock. This is an excellent opportunity for investors looking to bet on the future of AI and data centers. With Arista's Ethernet and AI capabilities, the stock is poised to continue its growth as more companies deploy generative AI technologies. Arista's growth isn't just about AI. It's about offering the infrastructure that powers AI. In the third quarter, Arista posted $1.8 billion in revenue, up 20% year over year, and earnings per share surged by 35%. If the S&P 500 continues its climb, Arista will likely see its stock price rise along with it. 2. Palo Alto Networks, a cybersecurity titan. Next up is Palo Alto Networks, PNW, another company that has been on an incredible growth trajectory. The stock is up 813% over the past 10 years, and management recently announced a 2-for-1 stock split. While the stock has held steady in the last year, its growth potential remains massive. Why? Cybersecurity is more important than ever, and Palo Alto Networks is leading the charge with its AI-powered security platforms. In 2024, Palo Alto Networks made a bold move to consolidate its security products into a single, unified platform, helping businesses close the gaps left by disjointed security systems. While this strategy initially scared off some investors, it's paying off. CEO Nikesh Arora mentioned that customers have been signing larger contracts, and the company's annual recurring revenue has surged by 40%. Palo Alto's Q1 earnings showed 14% revenue growth, and its EPS surged 77%, a sign that its strategy shift is working. Despite the stock's 51x P/E ratio, its PEG ratio of 0.15 indicates that the stock is underpriced for its long-term growth potential. Why buy now? Both of these companies have shown tremendous growth and executed successful stock splits, signaling confidence in their future performance. As the S&P 500 continues its climb, these two companies are prime candidates for continued strong returns. So, there you have it. Arista Networks and Palo Alto Networks are two stock split stocks that are not only poised for growth, but cheaper than they seem. With AI and cybersecurity booming, these companies have a bright future ahead, and now could be the perfect time to add them to your portfolio. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to The Finance Savvy for more insights and tips. Got questions? Feel free to reach out in the comments. We'd be happy to help. And make sure to stay tuned for the next video, where we'll dive deeper into the potential of Arista Networks and Palo Alto Networks in the 2025 bull market and explore other tech stocks that might just surprise you.